following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings, I'm Mike Hurley, Chief Market Strategist of NexPoint. Welcome to our weekly market deep dive for July 19th, 2021. Well, starting with commodities, as we like to, not much changed in the commodity markets last week or with foreign currency. You can see the US dollar, which is what we're watching most closely in the top center page, continues to battle resistance at the 93 area. And this is a critical area on the chart. Should the dollar get through this area, we think a further rally could ensue, which could mean a further pullback in commodity prices. Again, that might be welcome news on the inflation front, but strong commodities have been an indication or a confirmation of strong growth. So we would like to see commodities remain firm. So far, the Bloomberg Commodity Index, as you can see here in the middle center of the collage, have remained firm and are really consolidating in a sideways manner. So are copper, corn, and even crude. And while crude is starting to pull back, it's very natural given that crude is trading right near the 2020 highs. So looking a little deeper at crude on our next slide, you can see two contracts on the Brent crude contract or futures commodity. You can see both are getting near the area of those 2018 highs. So the white and orange line are the 1 month and 12-month forward contracts in Brent crude. And again, both are nearing this area which should be resistance around 2018 highs. Additionally, it's interesting or important, I should say, that OPEC did craft an agreement this weekend. So that extra supply coming on the market gives an even better chance of crude finding resistance in this high 70 to low 80 area. As for gold, gold remains firm and remains firm largely because of the wind at the back. You can see from the US 5-year break even less the 5-year yield and 10-year break even less the 10-year yield. Both of those ratios were up, or spreads were up on the week. You can see that in the top right chart, which puts a wind at the back of gold. That being said, there's a little bit of a divergence here between the two, and that's something we're watching because it typically is better when both of these are moving together with the same differences. I've also put the 10-year yield in red on the bottom of the chart. And again, you can see as rates weaken, it usually puts a wind at the back of gold. When rates strengthen or when rates rally, it usually causes gold to struggle. So again, very important relationship we're watching going forward. Looking a little deeper at interest rates around the globe as well as in the US, I want to first start with the chart on the left, which is the United States yield curve as of last week in the solid green line, as of last month, which is the dashed olive line, and as of 6 and 12 months ago, which are the dashed green and dashed gray lines respectively. The point being, you can see a positively sloped yield curve as you go from the 1 month tenor out to 10 months, which is a normal, healthy economic situation. That being said, the curve flattened over the last month, meaning the short end has fallen and the long has pushed up and the long end has pushed down. So again, a little bit of a lowering or flattening in that yield curve over the last month or so. Again, healthy yield curve longer term, but one that does seem to be under pressure over the short term. If you look to the right, you can see yields around the globe with the 10-year US break even on top and really leading the way higher off those March 2020 lows. Once the 10-year break even had been rallying for some time, the US 10-year followed suit, the British 10-year and those around the globe followed suit as well. The point we're looking at right now, however, is you can see the pretty significant pullback in that white line, which is the US 10-year Treasury. I would like to have seen that area hold 140. This does put the risk or the rally at risk, which we'll see here on the next slide. So looking a little more deeply into the yield market or bond market or US interest rates, you can see on the daily chart on the top left that after that powerful rally up to 1 3/4%, the US Treasuries have been spending the last 3 months or 4 months grinding their way sideways to lower in what looked like a normal, healthy consolidation range or trading range. That being said, last week or the week before, in our last week's brief, we noted the break down out of that trading range, which is a potential negative. What mattered to us was how the bounce looked and whether it was could get back through that trend channel or the 140 area on yield, or whether that would be resistance. That would be key to the call, whether this was a bear trap and washout or something a little more worrisome. As you can see, Treasury yields or the 10-year Treasury failed at the 140 area. Now they're back down to the lows around 130. And this is starting to look like a significant, serious breakdown to us. And again, one that could spread to equities. If you look to the right on the weekly chart, the last piece of good news is that the 5-year US Treasury is still holding the 70 basis point area. But again, we'd like to see the 5-year Treasury put a floor under the 10-year note wise or interest rate wise, as opposed to the 10-year Treasury pull down the 5-year Treasury. So again, we're at a very critical spot here in the Treasury market because weaker yields dispute the global growth that the commodity markets are seeing. So again, it's a potential deflationary measure, or I'm sorry, a stagflationary message that we're watching for. As for credit spreads, they've been trending lower for a year now. And while they're still down near their lows, they finally were wider on the week. Remember, these spreads are the spread between corporate bonds and US 10-year Treasuries, whether they be investment grade bonds, as you can see down here on the bottom, high yield bonds, or even CCC bonds in the purple line. But again, in general, very friendly market environment up until last week. And last week, we finally saw spreads start to widen. The CCC spread went up 0.25% roughly to 475. High yield went up 11 basis points to roughly 3.25. And even investment grade went up slightly to 107. So again, yields have definitely been a wind at the, or spreads have definitely been a wind at the back of stocks, but they're starting to move higher with some market weakness. Speaking of the market, this is our long-term look at where we are in the cycle as based on the value line arithmetic index, which goes back roughly 10 years. You can see several market cycles here, and the red and green vertical lines are based on when the bottom indicator goes above or below 40%. So as you can see, when the indicator goes below 40%, it's often a lagging indicator of a potential top, as it was in 2015. And when it goes back through to the north, it's an indicator of a potential bottom, which can be late, but still timely enough to identify the market cycle as it did in 2016, as well as in 18 and 19, and you can see the trends. Point being, we are likely still pretty early in this bull market, or maybe in the middle innings of the game, call it the 5th inning. Usually the tops are signified or marked with major divergences, as you saw here in 2014 to 15, as well as 2018 from February into the September timeframe. So when the market goes up and you see a definite second push higher in this indicator, but a weak second push in the indicator, that's when you're usually at a cyclical top and you're ready for a bear market. We're not seeing any indications of that yet because it's still too early. But again, if you look at those indicators, this is the first time the percentage of stocks on the value line have been below 75% since the value line was down around 7,000. So again, significant weakness. And as we noted last week, it's usually the indicators that weaken ahead of the indices. If you look at the RSI indicator, or an indicator of the overbought, oversold condition of the market, you can see it's coming off an overbought level, and the indicator has now weakened down to 55 and fallen through 60. So again, this suggests to us a correction might be at hand in the stock market. If you look at stocks a little more tactically, we have daily charts on the left, weekly charts in the middle, and then weekly charts of a couple of the various indices off to the right. And again, it continues to look like to us like a significant correction could be at hand in the market. And we base that opinion on some of those market internals we've been looking at for several weeks now. Some of the easier divergences to see are highlighted in red on those daily charts on the left. If you look at the red box, you can see that as the S&P 500 has moved higher, the number of new 52-week highs, or stocks making new 52-week highs, less those making new 52-week lows, has really dried up pretty dramatically from 667 down to 70. The NASDAQ, it's been drying up even longer, moving from 697 down to the negative territory since February. So again, it's very easy to see that when the market goes higher, fewer stocks have moved higher as well. What is not quite as easy to see, but still important, are the divergences in breadth, or the advanced decline line. And this is the brown line right under the S&P and the brown line right under the NASDAQ. This is another net number. And again, it measures the number of stocks going up less the number of stocks going down. So again, it should work in concert with the S&P as it did up until June. As the S&P made higher highs and higher lows, the number of stocks in the advanced decline line made higher highs and higher lows until this last rally. S&P moved to a higher high and the breadth line went sideways. So that's a very strong indication that the rally has gotten narrow and is really defined or dominated by a few large cap names such as Apple, Amazon, Cisco, Google, and the like. If you look at the breadth on the NASDAQ, you can see an even more concerning picture. And I've drawn a little gray vertical line there to show you exactly what I mean, which is right by the two. If you see 3 pushes up in the NASDAQ, one to just below 14 or just over 14,000, a second one and a third one at the peak, you can see breadth went sideways, as it is on the New York Stock Exchange now up top in this chart, as the NASDAQ went higher. And then as the NASDAQ went even higher to its third push, it made a lower high in breadth, meaning really it was just Amazon and Apple and Google that were pushing the market higher, and Microsoft, as well as a few other names. But a definite drop off in breadth, or the average stock was actually declining when money was pouring into those large cap names. Finally, there's one more indicator that we don't look at often, that I'd like to show, because it doesn't speak often, but it really is sending a pretty important message right now. And that is the net volume line here, just under the S&P. The brownish thin line is the cumulative average, or the net difference of up volume less down volume. And the purple line is up volume less down volume, but it's a 50-day average. If you look at that 50-day average, you can see it hovers in a pretty stable trading range. So just like the market has ups and downs, that indicator has ups and downs. And it doesn't really stray out of that range very much. And I assure you that range goes back even further than is on this chart. That being said, as the S&P 500 moved higher and above this 4,300 area or 4,250 area, that line actually shifted down, meaning not only have there been fewer stocks going up, but the volume on the stocks going down outweighed the volume on the stocks going up. So this is definitely a precarious situation in the market, where breadth and leadership are narrowing to the degree where we believe it's starting to get unhealthy. Point being, we think the rotation we've been seeing in the market could kick off a full-fledged correction sometime in the near future. The weekly charts look exactly the same, meaning divergences in breadth and leadership really abound. Here's the percentage of stocks trading above their 50-day average instead of their 200-day. You can see on the NASDAQ as well as the S&P or the NYSE, both of those indicators are putting out divergences. Additionally, if you look at the indices to the right, you can see that the indices up top, which are focused on large cap names such as the Dow Industrials, are healthier than some of those toward the bottom, such as the mid cap and even the small caps. We put Houston, we may have a problem with the small caps, because not only did the breakout in the small caps fail, but now the small caps are starting to break down. And you can see that not only in the chart with that dashed blue line I've drawn, but also in the relative strength of the Russell 2000 divided by the Russell 1000. This should have held one of these 3 dashed lines to the right. And you can see it's starting to give back the bulk of the relative gains that the small caps have earned over the large caps over the last 9 months. As for a few highlights I wanted to show a few stocks, not because these are recommendations of whether to buy or sell, but just examples of what we're seeing on the previous page and what's going on in the market. And this is important because, like the move in the 10-year Treasury, which had every reason to move higher when the government reported the unusually large or larger than expected CPI inflation numbers, interest rates should have moved higher. Bank stocks last week reported earnings, and really across the board, most of them beat their estimates by 20 to 40%. That being said, most of those same stocks moved lower on the news, and you thought they should have moved higher. So again, an important signal being flashed by the market that maybe this market's tired and ready to correct. So if you look at JP Morgan, you can see an important move through that's 2007 highs in late 2020, a move all the way up to the 167 area. But again, the stock not acting right despite the good earnings. So should it correct further, which we think is possible, and certainly we argued that based on the bank stock index last week, we think the stock could come down to the 140 area. It'd be a natural, healthy pullback in a bull market. We'll see if it gets there. If the stock holds here and moves higher and doesn't ever touch that support in the 140 area, then that would be a stronger than expected market, and one that probably has further legs throughout the cap structure. If it, however, comes down to 140 and fails and breaks that area of support, that would be weaker than expected action. So again, a couple stocks to watch that are important bellwethers and important canaries, and not really those we're trying to recommend buy and sell decisions on. Same with Bank of America. You can see the area of support right around 36. You can see Caterpillar and Deere in similar situations. Pardon me, a little weak over the short term, but stocks that have had incredible rallies off the COVID lows. In fact, CAT is up 3 times since then, and Deere is up almost 4 times since those COVID lows. So again, stocks that deserve a breather for sure, but we want to make sure those are only breathers they take and not something a little deeper. Finally, I wanted to look at Apple and Amazon, which we discussed on the previous slides. And again, you can see very nice breakouts in Apple and Amazon. In Amazon, it's a 1-year trading range the stock has come out of. In Apple, a little bit less. But in both cases, you would expect good rallies out of those large trading ranges. Facebook recently came out of a trading range and had a very nice rally, and that's a good template. So if these stocks can't rally, and if Apple falls back through 140, or if Amazon falls back through 3,400 and starts to damage those charts meaningfully, we think it could spread to the rest of the market, because these really are the last bastions of stocks holding up the market. Looking a little more at sectors, you can see it was a very defensive week last week. I put a red box around the 4 best performing S&P market sector spiders. And you can see at the top of the list, it was the utilities, staples, REITs, and healthcare, all 4 very defensive sectors, and sectors that usually do the best when the markets are down. You can also see a defensive tone in the fixed income market, meaning treasuries were up as people went out of stocks and into the safety of treasuries. Yet even though they bought treasuries, they didn't really buy investment grade bonds, and they certainly sold high yield bonds. So again, a very, very defensive tone to both the fixed income markets as well as the S&P sectors. As for the volatility surfaces, you can see the volatility surface on Friday the 9th versus Friday the 16th, and you can see there was some definite buying of protection in the markets. If you look at the difference, which is the slide in the top right, you can see even though we haven't seen huge spikes in the VIX yet, or a move in the VIX spot versus its 3-month forward, you can see people were buying protection, particularly in the 90 area, 90 moneyness, and right around the 1-month tenor. So again, this curve shifting up suggests people were more eager to buy short dated options that were heavy on the put side as opposed to heavy on the call side. Looking at some of the individual sectors as we like to, a couple of points to note here. First, you can see the put skew has trended up over the past month or so on the NASDAQ. And while the call skew hasn't broken yet, it may be close. This suggests people buying a little more protection on the NASDAQ than would meet the eye. Another place it's occurring is in the financial sector. Again, financial stocks reported earnings last week and didn't really act that great. We haven't seen the put skew spike yet, which would indicate a very eagerness in buying protection. But what we have seen is an eagerness in selling calls. So again, the call skew has collapsed through 60 and suggests people are being more eager to sell those, which again is probably what's going on in the market. Stocks aren't reacting well to good news, starting with the financials. We'll have to see if that trend spreads as the rest of earnings season proceeds. Another area where we think it's important to watch the put and call skew are the overseas markets. You can see put skew remains quite strong in Germany. That stock or that market is up near all-time highs and potentially poised for a correction. In Japan, you're seeing the put skew move higher and call skew move lower. So an even more significant message out of the Japanese markets than the German markets. If you look at the charts of some of those overseas ETFs and some of those overseas indices, starting with the top left with the all country world index, again, you can see a market like the US that looks like it's running out of gas. If you look back to the COVID lows in March of 2020, pardon me, you can see a strong rally with great momentum up until the middle of last year. Finally, the second push up into the early part of this year had even more momentum, but yet the third push had slightly less momentum. And the MACD, a popular trend following indicator, remains on a sell signal. So again, a classic case of a market that looks out of gas and ready to have sort of a mid-course or mid-cycle correction, a pause to refresh. Pardon me, as I clearly need on my voice as well. Looking at the DAX, again, continuing from the previous page, you can see the German market has been strong, but has really consolidated in a sideways action over the past month or so. Hasn't really made any progress after scoring all-time highs. Japan is one as well. The Japanese market, as measured by the EWJ, scored a new high in early 2021 in January, and has really been moving sideways and digesting that gain since. So again, possibly a deeper correction or certainly more consolidation to come in those markets as forecast by the options markets. Finally, two of our important bellwethers are the MCHI ETF as well as the ASHR ETF. These are ETFs which are focused on the Chinese markets. And as you can see, the Chinese markets were among the strongest off the COVID lows, literally gapping out of a trading range in the new highs in the April timeframe. I'm sorry, in the June-July timeframe. They were among the strongest into their highs around the January timeframe and have since been pulling back to digest those gains. So far, they're holding, although by their fingernails, support as well as the 40-week moving average as measured by the A-shares. So again, important bellwethers, because if these important ETFs, which represent the Chinese markets, start to buckle, we would expect buckling in our markets as well. So in summary, commodities have been strong, but they're now consolidating their recent gains. We think a lot of this is due to the dollar, which is bouncing off a very important area of support in the 90 area. Should the dollar get through this 93 area, we think the dollar rally could continue, potentially to the top of the range, and you could see an extended consolidation in things like copper, corn, crude oil, and a more lengthy consolidation and potential growth scare in the market. As you look at the 10-year US Treasury, you can see here you've gotten through 140 to the upside, but now fallen through it to the downside. While it's a little too early to tell, this is concerning action. And again, don't forget, this weakness in treasuries came last week when you had a very strong or stronger than expected CPI report. So inflation should lead to higher yields, and the fact that yields are going lower on the news is concerning. So far, stocks have remained strong, but we think that may change one day soon. You're finally starting to see internals form the third divergence, and I've blown up the chart to the right that we saw on the previous slide so you can see it a little bit easier. But as the S&P and NASDAQ have gone higher, you can see internals really haven't. You've seen the advanced decline line on the New York Stock Exchange go sideways. You've seen the advanced decline line on the NASDAQ composite start to actually buckle and form lower lows compared to where the market was in May and June. And you can even see a better view of the net volume line here that, again, remains rock solid above zero until just about a month ago. And finally, a little better look at that Russell 2000 that is clearly breaking its uptrend based on the March, April lows through the summer lows. So again, it looks like our market may be poised for a consolidation or correction, but a mid-cycle correction that should hold. We will certainly be monitoring it to make sure it does hold, because clearly that's an important thing to do. Finally, the overseas markets also look ready for a meaningful pullback, and it's good news the Chinese markets are holding support so far, because those probably will be an important bellwether for us. Okay, I've been Mike Hurley with your weekly market deep dive for July 19th, 2021. Please send us any comments you have, and we hope to see you again next week.